Welcome back to Bitcoin Treasuries. I'm here with Brian Cubellis, the Chief Strategy Officer at Onramp. How are you today, Brian? Thanks for
Doing well,
joining us.
Tim. Yeah, very, very glad to be here. Thanks for having me on. Yeah, doing well. How about yourself?
Doing well, thanks. Do you want to start by giving us a little bit of your background, your professional background, and your journey from traditional finance to Coinbase and then ultimately to Bitcoin only?
Yeah, for sure. It's been a wild ride. I'll say that up front. I started my career and spent the bulk of my career in the TradFi space, working on Wall Street here in New York. I worked for a private bank called Brown Brothers Harriman for about 8 years. Um, and frankly, when I graduated college, undergrad, I didn't really know what I wanted to do. I sort of always imagined myself working in finance. I grew up in northern New Jersey, so I always wanted to move to New York and do the finance thing. But I didn't really know what I was getting myself into. I studied history and economics in college. Um, Worth noting that I never really learned about Austrian economics, unfortunately, during my time in college. That would come later, but didn't know exactly what I wanted to do. I got a job at Brown Brothers, really more on the front office relationship management side of things. I quickly realized I was much more interested in the investment side of things, like where they were actually allocating that capital that they would gather from various private clients. And so I migrated over to the investment team within the private bank at Brown Brothers, and it was a very unique role in the sense that it operated, much more like an endowment or foundation investment team would, relative to, say your traditional private bank that you would imagine. So it was a very small, flat team. Worked directly with our CIO, and the day to day was really, allocating capital on behalf of our private clients. So it was mostly high net worth individuals, some smaller endowments and foundations mixed in there as well. But it was really our task to put together policy portfolios and, through a combination of both internal and external strategies, construct a portfolio for our clients. And it would vary sort of depending on risk appetite. But it was generally, my team going out and diligencing funds across the asset class spectrum. So everything from sort of US large cap mutual funds to private distressed credit funds. So it was a really fascinating sort of learning experience, and where I really honed my own personal investment philosophy, I would say. Brown Brothers as an institution is um, relatively conservative. It's a very old institution. It was founded in 1818. So, they have very much of a value orientation, sort of Warren Buffett disciples, if you will, cash flow oriented in the things that they look at. And you wouldn't you wouldn't at first glance think that that sort of investment philosophy or predisposition would eventually lead me to think about Bitcoin in a constructive way. But there are actually a lot of interesting parallels that I've come to over the years in terms of, Bitcoin in my mind is very much sort of the ultimate value investment, in the sense that value investing at its core is, finding mispriced assets, right? Buying something for less than you think it's worth. And there's some element of misunderstanding in the market that doesn't recognize the value of those assets. And that's really, I mean, that's the core of the Bitcoin thesis, is like most people don't understand what this is. And as long as you can assume, or, have some sort of framework for increasing demand against the static supply, then the price goes up. And so I was at Brown Brothers for a number of years. Like I said, um, I first started, thinking about Bitcoin just on my personal time in sort of 2017, the end of that bull run, and into early 18. Didn't know what I was looking at. Like many, I went through sort of had my altcoin phase for several months before honing in on Bitcoin, and I think I actually came in at the right time, at least from a certain perspective, in that when I first started looking at the space, it was pretty much right around that top. And so then everything started to collapse. And I ultimately noticed, like, okay, everything's sort of collapsing here, but Bitcoin is collapsing less than all these other assets.
Mm.
And so I sort of, asked internally, why is that? What am I missing here about Bitcoin relative to all these other assets? And that's when I really started to go down the rabbit hole of understanding what money is, Austrian economics, reading a ton of books, listening to podcasts. Um, and it was, yeah. So during that sort of ensuing bear market is when I really started to dig into Bitcoin specifically. And I just recognized, like, sitting in the seat I was at Brown Brothers, it was like, I have to understand this. Otherwise, I'm going to be behind in however long it takes for the rest of the market and TradFi to get up to speed on this. Like, this is something important. This is a new form of money. Like, I need to be able to speak eloquently to this because, I mean, back in those days, we weren't getting a lot of client questions about Bitcoin or crypto. It was very few and far between, but I sort of saw where things were headed, and I was like, well, we're going to need to be able to speak to this in an educated manner. And I would impress that upon my colleagues and my CIO. And back then, it really fell on deaf ears, partly because, as I mentioned, it was a very value oriented, cash flow oriented firm. And so we never had any exposure to gold in the
Mm.
portfolios for that
Mhm.
exact reason. So the concept of digital gold sort of just, people rolled their eyes at it. Like, why would we want that? We don't like regular gold. Um, and so that's what I was sort of up against from that 2017 era when I started getting into it personally. Was at the bank until late 21, and so those years were frustrating in the sense that, like, I knew it would be a long slog to do anything internally at Brown Brothers to get people up to speed with where I was in my understanding, because there was, at that time that I was thinking about leaving, so sort of late 21, there was like a digital assets working group at Brown Brothers that I was like, okay, maybe I sort of transition to that team, help them think through this. But they were very much down the sort of blockchain, not Bitcoin path. And
Mm.
I knew that that was going to be sort of an arduous path for me to take. And so I ultimately realized, like, I probably got to leave the bank to really pursue this growing passion, this growing interest that I had. And so from there, took a job at Coinbase, as you mentioned, which was interesting because at that point I was already sort of heavily convicted in Bitcoin and very skeptical of the rest of the crypto market and broader digital assets. But I saw that role. Basically, they were building out a dedicated research team within the institutional line of business, and so I was the first analyst hired to that team, and I really just saw it as an opportunity to codify my own thesis, because I was then sort of forcing myself to dig into some of these other protocols, research them, write about them, and really, codify that thesis around Bitcoin is truly different. And so I was there for about 12 months. I mentioned I was the first analyst hired to the team. I ended up being the only analyst hired to the team because a few weeks after I joined, they had a hiring freeze for my entire tenure and laid off 20% of the staff. If you remember, this was like right as that bear market was really um, getting started. And so it was a very interesting time to be at the business. But that was in some ways a benefit because it gave me a lot of autonomy on that team to research and write about what I wanted to. And so that ended up being mostly Bitcoin related research. But that other, call it 30 to 40% of my time, I did force myself, or my hand was forced to research and write about these other things. And it really did help me sort of get down to some of the fundamentals of why these other protocols don't make any sense. From just like the sort of incentive layers of the protocol itself. And so I came out the other side 12 months later, even more convicted in Bitcoin specifically. Um, and so probably 3 months or so before I left, I started to think critically about what would make sense for next steps. And I knew it was going to be something Bitcoin specific, and always sort of recognized that Coinbase was a stepping stone to that. But the other part of my brain was saying, okay, there's a few different sort of elements to consider here of, one, where is my skill set applicable? And two, what do I think is actually a sustainable business model in the Bitcoin space? Because frankly, to date, there haven't been a ton of Bitcoin only companies that have built sustainable, profitable businesses. Um, and so that's right around the time I heard about Onramp. So one of our co-founders, Michael Tanguma, was on a podcast in April of 2023, and he was talking about the launch of this business called Onramp. and this concept of multi-institution custody, which is really the foundation of everything we do at Onramp. Um, and it just immediately resonated with me as something that needed to exist in the market structure, in the sense that I had become very familiar with large pools of capital that were sort of around the hoop of a Bitcoin allocation. And even if they could get there on the investment thesis, they knew they needed exposure to the asset. They couldn't get comfortable with the custody of the asset itself. And so their options at that time were effectively, you trust a custodian, a single custodian unilaterally, like a Coinbase, or you try to figure out key management yourself, which particularly for like institutional allocators is just not a realistic or palatable path to go down. And then the other option was the Grayscale Trust, which existed prior to the ETFs, which had a number of issues with which many are familiar. But so that was the impetus for this hybrid sort of approach to custody that we call multi-institution custody, where it uses Bitcoin native multisig at its core. So a 2 of 3 key quorum. And then the main difference or sort of innovation of what we're doing is just distributing those keys to distinct entities. So Onramp only holds one of those 3 keys in our multi-institution quorums, and then we've partnered with other custodians to hold the other keys. And what that does at its core is it adds a level of fault tolerance and redundancy to Bitcoin custody that has never existed before. And because for the first 16 years, like the main pitfall in owning this asset has been custody. And you could make the argument like we haven't even figured out that element of this asset yet, in the sense that something like, I want to say it's like almost $700 billion of losses over the past 16 years have come from poor custody solutions. So that's both on the side of bankruptcies or hacks and or self-custody and people just losing their keys. So that's, for a $2 trillion asset, 700 billion has been just lost over time due to inadequate custody setups. And that's just a reflection in my mind of just how early we are with this asset, that we haven't even really figured out how to store the asset securely. And I think I would also make the argument, like, the reason we're not already at $1 million a coin is also related to these custody pitfalls, because particularly on the institutional side or just high net worth individuals that want to make a meaningful allocation, it comes back to just getting conviction and comfortability around the custody. Like, is that Bitcoin going to be there in 10 years? Is the exchange that I'm holding it on going to be there in 5 years? Like, there hasn't been a great track record for single entities, managing Bitcoin exposures, for a long period of time. And so the whole sort of concept of Onramp was founded on that notion of, there's a better way to do this. Let's use Bitcoin native multisig. Let's distribute the keys. Let's distribute the trust effectively, and add this level of fault tolerance and redundancy. And so, yeah, I reached out to Michael Colden. I said, however I can help you build this business, I want to be involved, because I think this is genuinely sort of how custody is going to evolve for Bitcoin. It's going to be more akin to, or more attached to, the ethos of the protocol itself, which is decentralization, distributed nature. It's completely antithetical to just say, yeah, we're going to let all the Bitcoin just kind of centralize in these single custodians like a Coinbase. That's very antithetical to like the asset itself, the protocol itself. So our vision of the future is like, there's a much healthier way for these larger pools of capital to adopt the asset in a way where they don't have to have that single point of failure with a single entity. And so that was really the thing that got me excited, and prompted me to join Michael and the team in building this thing out.
Hey guys, this episode is brought to you by Onramp. Bitcoin custody is evolving. Both self-custody and single third-party custody come with significant risks and trade-offs. Onramp is pioneering a new standard, multi-institution custody, which eliminates single points of failure, adding fault tolerance and redundancy to your setup. Onramp secures your Bitcoin in a segregated, cold storage, multi-sig vault guarded by 3 independent institutional-grade custodians, none of which have unilateral control. Multi-institution custody removes the technical, mental, and physical burdens of private key management, providing unparalleled peace of mind for you and your loved ones. To learn more, schedule a consultation with the OnRamp team. Go to www.onrampbitcoin.com. What would you say are some of your takeaways and learnings from traditional value investing, and what applications might they have to the Bitcoin thesis?
Yeah, I sort of alluded to this, but I think there's a few. Um, the first one is what I sort of referenced around, just like at its core, value investing is finding mispriced assets. Um, the other element worth mentioning is like most value investments, at least initially, look very contrarian. That would also be true of Bitcoin at this stage of the game. Um, the other element is, this is an interesting one, but a parallel around, the Buffetts of the world who sort of pioneered value investing. One of the sort of evolutions in their philosophy over time was saying, um, you know, cash flow generation is huge, but what's also very important is management excellence. So who's running the business, who's reinvesting those cash flows is actually hypercritical, because that's how you compound returns over time, is by reinvesting those cash flows into the business in an appropriate manner that's value accretive. Um, so you might think that doesn't map to Bitcoin, but in my mind, it maps perfectly in the sense that there's no management team that you need to trust. You're trusting code. You're trusting immutable mathematics. And so that's sort of the cleanest, most transparent form of governance or management that you could possibly imagine. The more apples to apples comparison is like you're not trusting the central bankers. And so that was a a learning for me of saying there's ways that I can equate this investment thesis for Bitcoin to everything I've learned in the value space, from just the contrarian nature of the bet itself. The I think there's also an element of um, like concentration being a good thing in a portfolio. Like that was one of the things. If I think back to my days at Brown Brothers, some of our best managers, just long only hedge funds, had like 6 or 7 stocks in the portfolio. So this notion, which I think became popular sort of over the past several decades, of diversification, your 60/40 portfolio, all of these things, it's actually sort of not super aligned with like traditional value investing, which is to say, if you find very mispriced assets, you should size that bet accordingly, i.e., heavily concentrate into that bet, or a handful of bets that are severely mispriced. And so that's what allows me to say, at least from a personal balance sheet perspective, like I'm okay being heavily concentrated in Bitcoin, because one, I have a ton of conviction in the thesis, but also like just from those learnings of like, if you see a mispriced bet, allocate accordingly. So there's been a number of things that I've sort of taken from my time on Wall Street in the TradFi space that I think map pretty neatly to where I stand with the Bitcoin thesis at this point.
Can you talk about Bitcoin's unique custodial considerations and why custody overall is so critical?
Yeah, this is a big one. So it's, Bitcoin is very different. It's a digital bearer instrument. So the most logical sort of comparison to make is gold, obviously, in that it's a bearer instrument. And what that means is custody actually becomes the most important part of your quote unquote investment thesis. And we've heard this, anecdotally in conversations with large institutional allocators that say, something to the effect of, I can live with getting an investment thesis wrong and XYZ investment going to zero. I can't live with getting the thesis right and still getting a zero because I screwed up the custody. And that's that's what people get fired for ultimately, but it's also very unique to this asset in the sense that your stocks and bonds are custodied by an entity, but at the end of the day, like those are just records on a ledger that can be replicated or reconstituted. Um, so there's not that finite nature of those other assets. And that's why for most other investments in the traditional world, like custody is just an afterthought. Like it's a box that you tick at the end of your diligence process. Um, whereas Bitcoin inverts that entirely. Like it's actually the first and like primary most important box that you need to check, because if you're going to have a multi-decade investment thesis on this thing, you have to be, have some confidence that the asset's going to be there in 20 or 50 years. Um, and historically, like I mentioned, like what we've seen is it's very difficult to trust a single entity in perpetuity, effectively. Um, the other element is, I think when it comes to self custody and managing private keys oneself, there's a place for it. But I think realistically, if we want to get to a $10 trillion market cap, $100 trillion market cap, like not everyone on the planet Earth is going to be holding their own keys. One, just practically speaking, it's not possible with the number of UTXOs available. But two, it's also just a massive barrier to entry for someone who wants exposure to the asset to say, hey, you got to go spend hundreds of hours figuring out how to manage this yourself. And oh, by the way, once you even do figure that out, there's still always the risk that you could screw something up. Even the most technically savvy people have still run into issues um, in securing their private keys themselves. And so ultimately what it comes down to is you need to be able to figure out a way to eliminate single points of failure. And, you might think that, if you're doing self custody and you have your own multi-sig set up and it's geographically distributed, like, well, okay, you're good. In some sense, maybe, but the reality is most people don't have two homes. So it's hard for most people to geographically distribute their multi-sig setup. And even if you get to that level, you still control the majority of the quorum, whether it's two keys and you're doing some form of collaborative custody, or you have all three, or if it's a 3 of 5 or something like that. You yourself are the single point of failure, because you yourself can comprise that quorum in order to sign and move funds. Um, on the other end of the spectrum, if you're trusting a single entity, that's obviously a single point of failure. And so what our solution really aims to do is abstract away that complexity and that burden of private key management, while at the same time distributing the counterparty risk so that you're not trusting a single entity. and the other just key thing I'd mention here is, like, you always have the optionality to take delivery of the asset from either our fund vehicle or our direct custody solution. You can always take your Bitcoin out. Like that is, I think, core to everything we do is we're not dogmatic and saying all of your funds need to be in a multi-institution custody vault. Like I personally will always have some amount of my stack that is in purely self-sovereign self-custody. And so there's this notion of, I referenced before, diversification. This is a different type of diversification in your different formats of custody. And so we think that that's super warranted to say, for some percentage of my stack, I want that to be like my bar of gold under my mattress that I personally am the only one who can have access to. And then for this other chunk, maybe that's a smaller chunk that's on like a hot wallet or a lightning wallet that I'm going to use for some random transactions. And then another chunk that's maybe like what I would consider long-term savings, which I want in a vault that I even don't have the keys to. Well, I control the keys, but I don't have physical possession of the keys. And that's the critical thing here, because, if you even just look at the past 12 months, there has been a massive increase in effectively like Bitcoiners and people in crypto being targeted by attackers, because attackers are waking up to the realities of a digital bearer instrument and recognizing that people hold millions, if not billions of dollars on effectively plastic devices in their desk drawer. And so it's a natural thing that I think we'll continue to see increase is the proverbial $5 wrench attack, right? Where someone is coming after you, threatening you or your family and saying, give me the passphrase or sign over, allow me to move these funds. With Onramp, that risk is mitigated because you yourself don't hold the physical key material. You instruct Onramp as sort of the owner of the client relationship. You instruct us to kick off a process that eventually moves your funds. Like it's actually purposefully sort of difficult to move those funds in some sense. Like it's like moving glaciers. Like it's going to take a little bit of time. Now you could, if you want to expedite it, you can probably have a withdrawal done in anywhere from 24 to 48 hours. But the reality of that process that gets kicked off when you submit a withdrawal request to OnRamp, we are then doing a verification process with the end client that you are who you say you are. You want to make this transaction. You're not under duress. If all of that checks out, we are them providing one signature. We then pass that half-signed transaction to our second key partner. They then they then do their own verification process with the end client. So there's two separate verifications by two distinct entities. Assuming that all goes well, then they provide the second signature, which allows the funds to move. So it's very robust and purposefully so, and makes it difficult for funds to move. And it makes it much more difficult for an attacker to basically social engineer or commit some other type of attack that is after your Bitcoin effectively. So I sort of rambled there for a bit, but that's why in some custody is really like the most important thing about thinking through an investment thesis around Bitcoin and then ultimately getting exposure.
My next question was going to be around multi-institution custody, and I feel like you touched on a lot of it, but could you dive a little bit deeper on the process, especially around the words you used, duress or social engineering, and maybe more pointedly to like the option of in-person verification? Because
Yep.
my thinking is just as the price goes from $100,000 a coin on up, we don't need to talk about specific numbers, but let's just say hypothetically we go up over time. I feel like that aspect of it could be really valuable and important to a certain segment.
Yeah, absolutely. And you hit the nail on the head in that all of this is a function of price in the sense that as the price continues to appreciate, on one hand, the burden from both a sort of physical and mental perspective of securing private key material that is ever increasing in its value, like that burden increases in tandem with the price. So that's sort of one half of it. The other half is what I sort of referenced around as Bitcoin becomes more mainstream, price continues to appreciate. More sort of bad actors wake up to these realities and say, hey, it's actually not that bad of an idea to target high profile Bitcoiners who I know or have an inkling that they hold private key material themselves. And I also think it's not out of the realm of possibility to say 10 years from now, just given everything we know about data leaks and, I don't think it's that crazy to assume in 10 years, some sleuth is going to be able to figure out how much Bitcoin you have and where you live. And so in that scenario, do you want all of your Bitcoin on a hardware device in your house? Probably not. And so to your question around the different permissions, so that's something we're working and focused heavily on. Is there's a number of different ways we can do this, but basically it's very bespoke. So whatever the client needs or wants, whether it's some sort of time delay that we can manually implement, where if you have certain thresholds set for the amount of funds that they're trying to move, that kicks off a time delay of some kind, we can do that. What you also mentioned is the in-person signing, which is super attractive for some folks in the sense that like you completely mitigate the notion of AI deepfakes or someone being able to spoof those video verifications that I referenced earlier, which is theoretically possible. I don't think we're at the stage yet where that's like a real real risk. Also, because it's redundant and there's two separate processes, like we have a better chance at catching that effectively. And you also referenced like determining if someone is under duress. So we have a few different protocols or processes uh, to implement that. I won't go into details on those specifics for obvious reasons, but there are various ways that we can be alerted that someone's under duress in those video verification calls. And then to your point, if someone wants to bypass that entirely, they can opt for an in-person verification in order to kick off that process for moving funds. So it's really, I mean, we like to describe what we're building sort of colloquially as like, a Bitcoin only private bank, in the sense that we want to provide bespoke financial services on top of this foundation of multi-institution custody. And so that includes things like these different permissions, these customizable permissions that people want on their accounts. And so, yeah, that's just sort of ingrained in everything we do and part of sort of the white glove service that we're trying to offer.
Can you help me walk through the trade-offs and risks of different custodial models? I mean, if we start from the ETFs, maybe that's the opposite of self-custody, where you don't even have a claim on the underlying Bitcoin, but you can sell
Hmm.
to cash at this point. Maybe maybe in kind will be coming at some point. And then from there, you're holding it on an exchange that's either multi-institution or single institution. Um, am I missing anything, or is there a deeper dive, or did we kind of cover most of single versus multi-institution?
I think we covered a lot of it. The other thing I would maybe add a finer point on is what I was sort of referencing earlier around not being dogmatic. Like there's different use cases, and um, there's different use cases for different forms of custody effectively. And so, I think there's a sort of a time and a place for all of these different methods. I think, on net, the ETFs existing is a massive positive for Bitcoin. Like I think that's pretty inarguable at this point. Um, Now, would I recommend the ETF to close friends and family? Probably not, because it's really no different than just owning coins on Coinbase. Like Coinbase is the custodian for 9 out of the 11 ETFs. Um, so it's just a wrapper that actually lets you do even less than if you just had the coins on Coinbase. Um, and so it's not an optimal solution. I think there's a place in the market, though, for effectively security like exposure. And so that's just to put a little bit more detail around our offering. So we have multi institution custody that people can go directly into. We'll set up a segregated vault for them. Um, the other method that people can work with us is through our trust vehicle. So we have a grantor trust, very similar to the ETF in its structure, but ours is obviously a private placement vehicle. But it uses multi-institution custody on the back end. But it's a pooled multi-institution vault that then we issue shares on top of. So that's a much better version of the ETF in our minds, because it, for one, allows both in-kind subscriptions and redemptions. So you can take the Bitcoin in or out of it without a
Mm,
taxable event. Currently
okay.
not possible with the ETFs. Maybe they get there. Um, but the reality is we can do that right now. And then the other component, which is the most important component, is it uses multi-institution custody. So there's no single point of failure in this setup. You're not just putting a wrapper around Coinbase effectively. And so I think what we're going to see over the coming years is a continued maturation of products like this that basically make the market structure more resilient and more robust. And it comes back to adding that fault tolerance, adding those redundancies to these different setups and these arrangements, and then ultimately the products that I think will put us in a much healthier position 5, 10 years down the line. And we maybe, ideally don't have as many blowups where people get completely screwed because we have a healthier market structure and better products and services out there. Back to the initial question around trade-offs, like it's also the other thing I would say about it is like it's different for everyone. And what I mean by that is people have different perceptions of different risks. So for someone who is super concerned about, let's say, a 6102 attack and the government, coming after their Bitcoin that's sitting at a custodian, then their percentage of their stack that's going to be in a more self-sovereign, self-custody setup is probably larger. But if they're being rational about it, they should have some amount that's outside of that in another form of custody that allows them to plan for the future, set up inheritance, beneficiaries, estate planning, all these different things that are much harder to do with self custody. And then, if someone, let's say on the, another side of the spectrum is saying, they really think there's a likelihood of that $5 wrench attack that I've walked through. If that's a bigger risk in your mind than the 6102 attack, then maybe you end up having more in a multi-institution vault and still some amount in self-custody, but it's less because you are concerned that if someone were to know that you held a good amount on on a hard drive, then that's a risk for you and your family. So it's also just about the perception of risk, of the individual. And then at the institutional level, it's slightly different in the sense that if you're a fiduciary, that kind of changes everything in the sense that like you need to be thinking super critically about custody, the trade-offs. Like I said before, you cannot afford for the allocation to go to zero, not because of the thesis, but because you picked the wrong custodian. That's how you get fired. That's how you lose clients in a fiduciary relationship. So on the institutional side, it's like even more critical that these firms think through these trade-offs. The other reality is like most institutional allocators are not going to do self-custody. They're not going to figure out key management themselves. So they're going to end up, outsourcing it or using a provider like us. So, yeah, those are just a few other thoughts on that topic.
Hey guys, today's episode is brought to you by Stampseed. If you're in cold storage, you know how important it is to protect your seed phrase. That's why I recommend you head over to stampseed.com and check it out for yourself. This seed phrase storage device is one solid piece of titanium. There are no loose pieces, and you can hammer your seed phrase in letter by letter. When you go to stampseed.com, use promo code TIM15 for a 15% discount across the website. That's TIM15. So we're in Q1 2025 right now. Can you speak to the current Bitcoin-centric financial services that you see in the marketplace and also what you expect to see moving forward?
Yeah. So I think a big one this year is going to be lending. And, I think it's partly always a function of a bull market is people wanting to borrow against their Bitcoin so they don't have to sell. So that's, I would say, the primary driver of the interest and demand around borrowing and lending. The other component, which I think is putting fuel on that fire, is the more of the institutional involvement and adoption that we've seen over the past 12 to 18 months. And it was kind of a meme or a joke in the space for the past 7 years of like the institutions are coming. Well, now they actually are. And there is certainly going to be an appetite for borrowing and lending. And so I think that's the big one to watch into this year is both new players, crypto native players, as well as traditional finance firms stepping in to try to support in that area. And hopefully doing so in a healthier way than has been done previously. So, i.e., not rehypothecating the asset for one, having very conservative loan to value ratios. And in our minds, the best way to do this is also using multi-institution custody because it allows a greater transparency into the underlying and also allows for better governance of whether it be margin calls or liquidations having to occur. There's just greater governance and transparency in that setup. And so if you look at the last cycle, when a lot of firms blew up doing, the antithesis of this, so rehypothecating the coin, having single points of failure, single custodians. I believe the only lending desk that didn't blow up was Unchained Capitals, which they use a very similar model to ours in that they use Bitcoin native multisig. So our, just for context, our co-founder and CEO Michael Tanguma came from Unchained before founding Onramp, and so he oversaw them building out that lending desk and really doing it in the right way. Very conservative loan to values, again using that transparent form of custody on the back end. And for those reasons, I don't think they ever had a loss on their loan book. And so I'm hopeful that this time around, we see a healthier market structure develop, and the lending market matures in just a healthier way. I think so. That would be the big one. I think there's also lots of talk around insurance, which has always been a thorny topic in the crypto space, in the sense that, for, let's say you're holding coins on Coinbase, their quote unquote insurance policy is for a minute fraction of the assets that they hold. So like, there's never going to be a scenario in which there's a massive loss on Coinbase and they can actually pay out that claim effectively, let alone if there were multiple claims at the same time and there was actually an internal failure from a key management perspective. So it's sort of, insurance to date has been largely marketing, and less like actual insurance. And so I think there's some interesting firms working towards having more robust forms of insurance around Bitcoin custody. But the one thing I would add there is, like, in our minds, the best form of quote unquote insurance is actually just how you manage the private keys. Because if you're doing it in a way that is fault tolerant and redundant, i.e., multi-institution custody, your chances of having like a catastrophic loss are magnitudes lower, in the sense that one of the three key holders could have something go wrong and all the funds are still safe. That hasn't been true to date until this form of custody sort of arrived. But I think that's, layering different forms of insurance on top of single counterparties, like, in my mind, doesn't make a ton of sense. But where it starts to be very interesting is layering insurance policies on top of multi-sig effectively. So I think that's also ultimately where this goes. Trying to think of other sort of financial service. I mean, one that we've had a lot of success with already is just the inheritance side. So more on the private client side, less sort of institutional focus, but multi-institution custody, everything we're doing at OnRamp allows for very seamless inheritance planning. So naming beneficiaries, making sure that upon death, assets don't enter probate, and there's long, arduous processes if that does occur. And so that's one that we've already seen a ton of success in terms of sort of just top of funnel for our business in general, people wanting to figure out how they're going to pass these assets on, right? Like, I think part of the reality that there hasn't been a ton of focus on that to date is just like literally age demographics. Like, most Bitcoiners are not at the age where they're considering death. But obviously that's changing as time progresses forward. And so people are starting to think, well, okay, how do I make sure that my family actually, gets these coins if and when I pass? And that's very difficult to do if you're doing self-custody. It's basically, you leave a treasure map and hope that your family can recover the keys. And even if they do, there's not necessarily a legal transfer of title of those assets, which is then when it can maybe enter probate and a court process, which is not ideal. And so using, being an on-ramp client and using multi-institution custody allows all of that to be streamlined. And it's a very attractive thing for someone. Again, like, it doesn't have to be your full stack, but at least some portion, is going to get to your kids if something bad happens. That's a really big selling point for us. And, just gives people peace of mind that if something were to go wrong, at least some amount of their hard work and effort will be passed on to their loved ones.
Can you speak either generally or specifically to the segments of the business, so like the private client side and the institutional side?
Yeah. So it's interesting. The first product we launched was the trust. So before you could even come in directly and create a segregated multi-institution vault, the trust was actually the first product that we launched with, and that was mostly geared towards institutional allocators who were looking for a superior alternative to the ETFs, or at the time the Grayscale Trust. Um, what we quickly realized was that there was a ton of demand for the underlying custody structure and someone to come direct. And so that's when we kind of opened up the funnel of the business to be more really, as it stands today, there's really two segments of the business: individual private clients, and then institutional allocators. And where we've seen, the bulk of our traction over the past year and a half has been the private client side. And I think part of that is just natural. Like, you're going to have the earliest adopters of a new form of custody be, come from the individual side as opposed to large institutions. We've had some success on that side, but it's just a much longer sales process effectively. So there was a headline back in November of last year that the first pensions in the UK to allocate to Bitcoin actually did so through the Onramp Bitcoin Trust, so through our trust vehicle. That was announced in November, but that was a 12-month diligence process. So that was a long time in the making. And so I think that's just the reality of the institutional side of the business. And so for the past 12 months or so, we've really gotten the private client and individual side humming. A lot of that, like I said, has been the intrigue and the appeal around setting up inheritance, and also just like offloading that burden of private key management. Like, we, every time we onboard a new client, like, there's a visceral like sigh of relief from the individual of like, all right, I feel good about this now. I'm not worried about it. For at least this portion of my stack, it's, in good hands, and also not in a singular entity's hands. And so I think as we enter the new year, we're going to have sort of a renewed focus on the institutional side of things. We have a few things planned that will be announced in the coming days and weeks. But, effectively, part of the offering on the institutional side is less of an aggressive sell around our products themselves, whether it be the trust or direct custody, and more of a pitch around, education and advisory, in the sense that we talk to institutions every day. The level of sophistication and where they are in their understanding of Bitcoin, digital assets, all these things varies pretty widely. And so part of what we think our sort of special sauce and secret ingredient is, like, we can be that trusted educator first and foremost, and eventually you'll come to us for our products and services beyond that when you actually want to get exposure to the asset. But first, you need to understand the asset itself and why we're even doing all this stuff on the custody side. Like, that's something we've run into, is like, it's very hard for someone on the periphery of Bitcoin to sort of grok or understand what we're doing on the custody side if they don't have the same reverence for the asset that we do, right? Like, we've talked with firms who, they've quote unquote done their diligence on crypto and digital assets, and so they're, they put it in a risk bucket, obviously, like a high risk bucket in their portfolio, and whether it's like 1% to 2% of a basket of cryptocurrencies, they view that very much as like a risk on flyer bet. Like, our view of Bitcoin is the exact opposite of that. Like, it is a risk off asset in our mind that shouldn't be a flyer allocation. And the reason I think some of these folks, like, their eyes glaze over when we talk about multi-institution custody, because they're like, why would I care about the custody if, like, this thing could go to zero anyway? And it's like, well, that just sort of shows your lack of understanding of what's happening here. The reason we're so focused on custody is because we know this isn't going to zero. It's going much higher, and it's going to become a larger and larger percentage of your portfolio. So you're going to want to feel good about the custody. And so that's just like that goes back to the sales cycle and why it's a longer sales cycle. It's just like there's education that needs to occur. And so that'll be a focus of ours this year is really offering ourselves up as experts in the field, but also like able to speak to any level of sophistication and get people up to speed on the asset, how it fits into our portfolio, and then ultimately how to think about custody. But that really comes last because, like I said, you need to understand the asset first to understand why our form of custody makes sense. Um, so yeah, those are sort of the two segments of the business today: private client and institutional. I should also say we don't have technical minimums on the private client side, but there are sort of some base fees. So there's a certain threshold at which it makes sense to be an on-ramp client. Um, but if you're at all interested in learning more about what we do, please reach out and don't feel like you're sort of outpriced by our services. Like we're willing to work with most folks.
Could you walk us through how you view opportunity cost and maybe how you think about Bitcoin as the hurdle rate?
Yeah. Um, I do think Bitcoin is the hurdle rate, is the opportunity cost, and what that really means, if you break it down, is if you're going to go from like a personal balance sheet perspective, like if I'm going to go buy a car, would I rather have the car or would I rather have the Bitcoin? Like that is the calculation in my head for every single purchase I make. Um, and I think what we're beginning to see early signs of is obviously like that's the process of becoming a Bitcoiner, right? Is like shifting your worldview, shifting your unit of account to Bitcoin, and measuring everything else against just holding or accumulating more Bitcoin. What we're starting to see, and what you've been sort of totally on top of, is uh, companies recognizing that. Companies recognizing like the the hurdle rate is not uh, whatever the Fed sets interest rates at. Like that's not the hurdle rate. The hurdle rate is effectively, well, what else could I do with these dollars? I could put it in Bitcoin, the best performing asset of the past 16 years. Um, Now, obviously, you need to have a thesis and a deep understanding of the asset to get to that point. Um, but it's not, it's when I describe like my high level thesis on Bitcoin, like it sounds simple because it is. It's literally supply and demand. So like if you have a sense for demand increasing for this non-sovereign global digital form of money that can't be debased, as long as you think demand's increasing for that, the price necessarily has to go up. And if you believe those things to be true, then you ought to be denominating in that asset and not denominating in the one that's being printed infinitely. And so that's really um, I should mention, so outside of my role at Onramp, I'm also a partner at a firm called Early Riders that Michael Tangum and I also helped start. Um, and what that is a Bitcoin denominated venture fund. And it's really a distillation of the thesis we're talking about now, in the sense that Bitcoin is the hurdle rate, it is the opportunity cost, and therefore you should denominate all of your investment activities in in that unit. And so when we looked at sort of the market of sort of Bitcoin only venture firms, there's a handful out there, um, all doing interesting things. I think they're all going to be relatively successful for if we're right about this Bitcoin thing. But what never sort of stood right in our minds was raising dollars and returning dollars to LPs. Like why would your goal be to return dollars to your investors? Um, if we have a constructive thesis on Bitcoin as the best form of money, like you should be returning the Bitcoin to your investors. And so that was sort of how we inverted that thinking and said, no, let's denominate the fund, let's raise capital in Bitcoin, let's deploy capital in Bitcoin, and ultimately return incremental Bitcoin to our investors. And frankly, like I think that's like the future of all investing. Like I think, hence the name of the fund, Early Riders. Like we're just very early to people recognizing Bitcoin as the hurdle rate and the opportunity cost, because what that does is it fundamentally shifts how you allocate capital. Um, because it's just like do I go buy the car? It's, do I go hire XYZ person, or do I figure out how to do that with AI way cheaper and way faster? So it forces you to build within constraints, which is actually just like a fundamentally better way to build in our minds, because the opposite is kind of what we've seen occur in venture capital over the past couple of decades is grow at all costs, get your head count up, burn all the money because you got to get those numbers up so that you can raise again in a year or two. In our model, like ideally the founder, the entrepreneur only raises capital once. Therefore, they don't have to dilute themselves as much, in perpetuity into the future as they need to raise bigger and bigger rounds. Like, no, ideally you raise once, you hold, a portion of that in Bitcoin, you deploy it very cautiously, and then as that business accrues value, spits off cash flows, whether it's in dollars or sats, you're converting those cash flows back into Bitcoin and adding to that treasury over time. And then maybe you don't have to raise again. And so you own more of your business 10 years from now. And so there's a lot of different ways in which this sort of thesis is really centers around just aligning incentives from the LP to the GP in our seat, and then ultimately the founder, the entrepreneur who we're giving the Bitcoin to. Like, they need to also have some reverence for the asset and understand, sort of, again, going back to the initial question, like, this is the hurdle rate, this is the opportunity cost. If you're going to take this Bitcoin from us and go do XYZ thing with it, it better produce more value than if we had just kept it in the Bitcoin. That's sort of at the end of the day what we're driving at, and we genuinely think that just makes people makes us better investors, and it makes our founders better capital allocators at the end of the day.
Really appreciate you joining us today. Do you have any final thoughts, and where can people find you and Onramp online?
Yeah, no, thanks for having me, Tim. This was fun. I my only thought is next time I got to come in studio and throw on an orange tie. I think that's
Let's do it. Let's do it.
But yeah,
I was
people
thinking
can
that as well.
Yeah, people can find me on Twitter at /BTC, at that, like the word /BTC, and then onrampbitcoin.com. Check us out, and you can schedule a consultation with our team there from there, and just learn more about what we're doing, and if there's any ways that we can help you in your Bitcoin journey. But thanks again, Tim. This was fun.
Yeah. Thanks for the time.